while the entire world was glued to the flashing red and green numbers on the stock market charts this past week. The real decision, the decision that actually determines the fate of your wallet, was made behind closed doors in Basel, Switzerland. This isn't a rumor. This isn't a conspiracy theory from guys in tinfoil hats. This is an ultimatum, a signed regulatory mandate that goes into full effect the second the markets open this Monday morning. They passed it quietly. Why? Because the people running the show know that the plumbing of the global financial system is about to be torn out and rebuilt forever. If you have money in a bank, or if you hold any paper assets, you are standing at ground zero. The group behind this is the BIs, the Bank for International Settlements. Think of them as the central bank of central banks. They are the boss of the Federal Reserve, and they just pulled the trigger on the final phase of a rule set called Basel III. The name sounds dry, doesn't it? But don't let the boredom fool you. This is a death sentence for the era of fiat currency and paper gold. Let me give you the simple version so you can understand. For 40 years, big banks like JP Morgan and Citi have played a massive game of make-believe. They sold investors paper contracts, promising that they represented gold or silver, but in reality, their vaults were empty. They called it unallocated gold. They sold you a receipt, took your real money, but never actually bought the gold to back it up. It was an empty promise, a legalized lie, because it cost them nothing to store it. They could print billions of dollars in paper gold to short the market and manipulate prices whenever they wanted. But starting Monday, that lie stops working. The new Basel III rules change a specific technical metric called the NSFR net stable funding ratio. I know it sounds incredibly boring, but wake up, because this is where your money either evaporates or multiplies. This new rule dictates holding paper gold is now extremely expensive. It heavily penalizes banks for holding short positions without real assets to back them up. The cost to manipulate the price, which used to be near zero, has just skyrocketed to extortionate levels. The banks are backed into a corner with two choices. 1. Spend real capital to buy heavy physical metal to fill their vaults. 2. Get out of the precious metals market entirely. The original intent of this law was to stop another 2008-style crash, but ironically, by passing it, they lit a fuse. JP Morgan can no longer hold billions in short positions without real capital. What are we seeing in the market? Banks are quietly, desperately unwinding their positions in the overnight markets. They are scrambling to comply before the deadline. The buying pressure building up isn't speculation. It is the banks trying to save their own lives. This is the part the mainstream news forgot to tell you. The most bullish part of this rule isn't the penalty on paper, gold, it is the reclassification of gold. Until yesterday, risk managers viewed gold as a risky asset, just like a volatile stock. But starting Monday, gold is officially a Tier 1 asset. What does that mean? It means physical allocated gold is now considered risk-free capital, legally equal to physical cash in the vault or U.S. Treasury bonds. Think about what this does to a banker's brain. Previously, they wanted to sell gold to suppress the price and keep the dollar strong. Now, the regulations incentivize them to buy gold to strengthen their balance sheets and prove financial stability. They are shifting from price suppressors to asset hoarders, when the biggest sellers in the world suddenly flip too. But the tragedy doesn't stop at the banks. Industrial giants like Tesla, Samsung, and Apple aren't stupid. They read the same reports we are reading. They know that once the banks stop selling paper, the price of metal will explode to meet its true value. Silver isn't just money, it is a critical component in EV batteries, solar panels, and every electronic device. We are witnessing a brutal two-horse race. On one side, factories panic buying to secure supply for production. On the other side, banks desperately sucking up physical gold and silver to meet their NSFR capital requirements. The problem, there isn't enough silver for both of them. Physical supply is finite. You cannot print silver like you print dollars. When physical demand collides with a constrained supply, the price won't move in a straight line. It will go vertical. Looking at the geopolitical chessboard, the implementation of Basel III is essentially a white flag from the West. China has been playing this game for months, even years. The Shanghai Gold Exchange only trades fully allocated physical metal. They don't play the paper games. They know the value of real assets. By passing this rule, Western regulators are silently admitting the Chinese Model 1. They are admitting that paper derivatives are trash, they are dangerous, and that physical metal is the only true safety. The system is shifting from a dollar standard to a neutral system based on real assets. This is historic, on the same level as the Nixon shock of 1971. In 1971, the government severed the dollar from gold to print money endlessly. In 2026, Basel III is silently moving us back to metal. A massive, painful U-turn. But here's the most interesting part. A deadly trap called the doom loop that the banks accidentally created for themselves. To comply with the law, they need to buy physical gold. But when they buy, that action drives the price up. And because they still hold massive short positions from before, as the price rises, they lose billions. They are trapped. Complying with the law means destroying their own profits. To save them, the Federal Reserve will be forced to do what? Print more money to bail out the banks as they try to buy gold. Printing money causes inflation. Inflation makes the price of gold rise even higher. Higher gold prices mean the banks need even more capital. It is an inescapable spiral, and the only winners in this chaos are the people holding physical metal in their hands. So how does this affect your dinner table? Don't think this is just a billionaire's problem. Basel III is going to hit your wallet in a way you might not expect. Because banks must hold more real capital, gold, silver, in their vaults, they will have less money to lend out. The credit spigot is turning off, starting next week. Getting a mortgage or a business loan will be harder than ever. This is a credit crunch. The economy will slow down due to a lack of capital. But the Fed is printing money to save the banks. Slowing economy plus massive money printing equals stagflation. In a stagflationary environment, stocks are risky, bonds are trash, real estate is illiquid, only gold and silver are king. History has proven this through every economic cycle. Furthermore, you need to prepare yourself for a phenomenon known as price decoupling. Do not trust the spot price you see on CNBC or your trading app. That is the price of paper. In the coming months, we will see a split. The screen might show gold at a moderate price, but try to buy an actual coin, and the dealer will ask for double that amount if they have any stock at all. We are moving toward a state of unobtainium. The mines will soon bypass the public entirely to sell directly to sovereign nations and desperate banks. You won't be complaining about the high premiums. You will be begging to find a seller at any price. The window to convert your fiat currency into real assets is closing, and the lock is already clicking shut. There is a specific danger I must warn you about right now. If you hold an unallocated gold or silver account at a bank, you are in the crosshairs. Holding that account is now a liability for the bank. Don't be surprised if you get a polite letter next week saying, "We are discontinuing our precious metals program. Here is a check for the cash value." They don't want to hold the metal for you. They need that metal for themselves to save their own skins. They will pay you in paper currency, which is losing value by the second, and they will keep the real gold. Do not bet against the house. If the banks are being forced to hold physical metal, why are you holding paper money? If the banks are fleeing paper derivatives, why are you still holding them? The financial system is preparing lifeboats, and those lifeboats are made of gold and silver. The only question left is, when the flood hits, are you sitting in the boat? Or are you clutching a handful of paper receipts as you sink to the bottom? Stop looking at the spot price of $91. That number is a lie. Right now, as you watch this video, the price of silver in Shanghai, China has already exploded past $114. $114 an ounce. That is an $11 to $12 premium over the COMEX price in the United States. In percentage terms, that is a massive arbitrage gap. But if you think that spread is shocking, what is happening inside the United States is even worse. The system has effectively seized up. We have received official confirmation that the United States Mint, the sovereign producer of the American Silver Eagle, has ceased operations on silver sales. They have shut the doors. Their official statement claims they need to evaluate pricing adjustments. Let me translate that from bureaucratic speak into plain English. It means the price of silver is rising so rapidly, so violently, that the US government cannot update their website fast enough to stay profitable. They are literally terrified of selling dollars for dimes. They realized that their fixed pricing models were being arbitraged by the market, and rather than losing money on every ounce sold, they simply pulled the plug, and they aren't the only ones. Costco, the retail giant, is now rationing bars like we are in a wartime economy. They have instituted a hard limit, 1 transaction per membership with a maximum of 10 units per 24 hours. And even with those limits, the inventory is flashing sold out almost immediately. We are watching a commercial signal failure. The West is trying to suppress the price to keep the illusion of currency stability, while the East is draining the vaults at any price necessary. Even $114. And in the middle of this chaos, the CME Group has dropped a nuclear option on margin requirements that changes the rules of the game forever. If you thought $91 was the story, you are missing the forest for the trees. The real story is that the physical market has decoupled from the digital price feed. This is not just a bull run. This is a paradigm shift. While the physical metal is disappearing from the U.S. Mint and Costco, the paper markets are launching a desperate counterattack. Faced with this runaway train, the exchange authorities have made a historic, unprecedented change to the rules of engagement. We are calling it the eternal margin nuke. Traditionally, when you trade a futures contract for gold, silver, platinum, or palladium, the exchange sets a margin requirement, a fixed dollar amount. For example, to hold 5,000 ounces of silver, you might need to put up $32,000. It was a manual, deliberate process. That system is gone. Earlier this week, the CME Group announced they are switching from a fixed dollar margin to a percentage of notional value. They are effectively pegging the margin requirement to roughly 9% of the total contract value. Why is this huge? Because it automates the pain for the bulls. Let's break down the math. A standard silver contract is 5,000 ounces at $91 an ounce. That contract is worth $455,000. $455,000. Under the new rule, you need 9% of that in cash, roughly $41,000. But here is the trap. As the price of silver goes up, the value of the contract goes up. Therefore, the 9% margin requirement goes up automatically if silver hits $100. The contract is worth $500,000, and your margin requirement jumps instantly. If it hits 150, it jumps again. This acts as an automatic braking system on the price. Every time silver rallies, it becomes more expensive to hold the position. It forces leverage out of the system. It creates a scenario where traders are constantly hit with margin calls simply because their asset is performing well. Some might argue this is just to streamline operations. But if you look at the timing, right as silver goes parabolic, right as the physical shortage hits, it looks like a desperate suppression tactic. It looks like the comics saying, we cannot afford to let this market run, so we are going to make it prohibitively expensive to participate. It is a Hail Mary attempt to save the short sellers. But here's the flaw in their logic. This only affects the paper speculators. It does not stop China from buying physical bars. It does not stop the U.S. Mint from running out of coins. All this does is widen the disconnect between the fake paper price and the real physical price. Let's circle back to the implication of the U.S. Mint shutting down, because it is critical to understand the economic gravity of this. This is exactly what happens during a hyperinflationary event or a currency collapse. You walk into a store and there are no goods on the shelves, not because the goods don't exist, but because the store owner doesn't know what to charge you. If he sells you a loaf of bread for $5 today, but it costs him $10 to replace it tomorrow, he goes out of business. The U.S. Mint is currently facing that exact dilemma. They are paralyzed by the velocity of the currency debasement relative to silver. This is not a private dealer. This is the sovereign mint. When the government stops selling its own money, Silver Eagles, and when the biggest retailer in America, Costco, has to ration a commodity, price discovery on the screen becomes irrelevant. The price of silver isn't $91 if you can't buy it for $91. The real price is unobtainium. We are seeing the physical market decouple from the digital price feed. The dealers are backed up, shipping times are delayed, and the banners on every bullion website are asking for patience. This is what a supply squeeze looks like in real time. While the West struggles to price silver and manage margin calls, the East has already moved on. This East-West divide is a geopolitical economic war. In a functioning, efficient global market, an arbitrage gap of this size, $91 vs $114, shouldn't happen. Traders would buy every ounce in New York, fly it to Shanghai, sell it, and pocket the risk-free profit. That process should bring the prices back together, but the spread remains. Why? Because the metal isn't moving fast enough. Or, more frighteningly, because the metal available in the West is paper silver derivative contracts that cannot be easily converted into the physical bars needed to satisfy the Chinese appetite. China is bidding for physical delivery. They are draining the global supply. They don't care about the COMEX closing price, they care about possession. We are seeing a massive flow of physical wealth from west to east. The West, specifically the US and London, has suppressed the paper price of metals for years to make the dollar and the pound look stronger than they are. But China, knowing the geopolitical landscape is fracturing, is calling the bluff. They are saying, we will pay the real market price, and that price is over $100. This puts the COMEX in a death spiral. If they don't let the price rise to match Shanghai, their vaults will be emptied. If they do let the price rise, it exposes the inflation and currency weakness they have been trying to hide. We are watching the end of Western price dominance in precious metals. Markets do not move in a vacuum. This silver explosion is being fueled by a backdrop of extreme political instability in the United States and abroad. According to analysis from Bloomberg, this rally is being driven by a combination of the Trump trade and uncertainty surrounding the Federal Reserve. There is a growing narrative in the market regarding the independence of the Federal Reserve. We are hearing reports and rumors about potential criminal indictments against Fed Chair Jerome Powell, or at the very least, a significant push to remove him from power. The market hates uncertainty, but the precious metals market loves it. If the independence of the central bank is compromised, or if the market believes the next Fed chair will be a political appointee instructed to slash rates to zero, the dollar is effectively dead in the water. Lower rates and a politicized central bank are the ultimate rocket fuel for gold and silver. Investors are front-running this possibility. They are buying insurance against a regime change in monetary policy. Add to this the aggressive foreign policy moves we are seeing. The transcript highlights tensions involving the Trump administration's actions in Venezuela, capture of leadership, and renewed rhetoric regarding the acquisition of Greenland. These are not normal geopolitical maneuvers. They signal a return to a more aggressive, imperial style of resource acquisition when the world sees the US becoming unpredictable on the global stage. And when they see internal strife in Iran with violent protests threatening the regime, capital seeks safety. Safe haven assets are not just about inflation, they are about political risk. Right now, the political risk meter is in the red. Investors are looking at the US debt, the political infighting, the geopolitical aggression, and they are saying, I don't want dollars. I want something with no counterparty risk. That something is gold and silver. Despite all of this, the $91 price, the shortages, the margin hikes, the $114 China price, the most incredible thing is that we haven't even seen the mania yet. If you look back at 1980, when the Hunt brothers cornered the market, or 2011, when silver nearly hit $50, those were periods of public hysteria. People were lining up around the block to sell their grandmother's silverware, or to buy coins. We aren't there yet. The retail public is just waking up. The buying we are seeing right now is institutional. It is sovereign. It is the smart money moving first. The average person on the street has no idea that silver is at $91. They have no idea the mint has shut down. This suggests that we are still in the early to middle innings of this move. When the mainstream media starts covering this 24/7, when your taxi driver gives you stock tips on silver miners, that is the top. We are far from that sentiment. Citigroup has upgraded their forecast to $100 silver and $5,000 gold in the next 3 months, but honestly, that feels conservative. If China is already paying $114, why would the price stop at $100 in the US? The ceiling has been blown off. The inflation-adjusted high from 1,980 is the only record left to beat, and given the rate of currency creation since then, silver could theoretically go much, much higher before it reaches true equilibrium. To wrap up this analysis, we have to look at the consequences. What happens next? We are likely going to see a period of extreme volatility. The COMEX margin changes will force some paper hands to fold, creating temporary dips. But those dips will likely be bought aggressively by the physical market. The floor has moved up. The US Mint will eventually reopen sales, but you can guarantee the prices will be significantly higher. They aren't going to sell silver at a loss. The premiums on physical metal will likely stay elevated or expand further. We are moving into a two-tier market, the paper price shown on CNBC, which might be managed and suppressed, and the street price, or Shanghai price, which is the actual cost to acquire metal. For the investor, the lesson is clear. Do not rely on the spot price to tell you the value of your asset. The spot price is becoming a fiction. The true value is determined by availability. If you cannot get it, the price is infinite. We are witnessing the slow-motion death of the fractional reserve bullion banking system. They sold more paper silver than exists in reality, and now the holders of those contracts, led by China, are standing at the cold delivery window asking for their bars. The window is closing, the mint is closed, Costco is limited. The question you need to ask yourself is not will silver go to $100? It is already there in the places that matter. The question is, what will you hold when the paper market finally admits it has nothing left to deliver? Gandalf the Grey, or rather, the meme version of him mentioned in the news, said it best. Hold on tight to your physical gold and silver, you fools. It's satire, but it's also the best financial advice of the decade. The ratio is dropping, the price is climbing, and the exits are being blocked by margin hikes and sales suspensions. We will continue to monitor this historic squeeze. As the East continues to bid up the price and the West struggles to maintain the illusion of control, one thing is certain. The silver market you knew yesterday is gone. Welcome to the era of true price discovery. Thank you for listening. This has been a special report on the silver crisis. Keep your eyes on the Shanghai spread and prepare for volatility. Forget the S&P 500. Ignore the Dow. If you want to know the truth about the global economy right now, look at the only chart that isn't lying. We are witnessing a historic break in the system. Gold didn't just hit a new high today. It shattered reality, crossing $4,600 an ounce. And while everyone was watching gold, silver quietly turned into a monster surging past $84. Make no mistake, this isn't inflation. This isn't a bubble. This is panic. Money isn't just walking to safety, it is running for its life. Why? Because three massive crises have just collided at the exact same moment. A Middle East on the brink of war, a U.S. economy hitting the brakes, and an unprecedented civil war in Washington between Donald Trump and the Federal Reserve. The system is blinking red, and today we explain why. Let's start with the first pillar of this rally. Geopolitics. The situation in the Middle East has moved from tense to critical. The crisis in Iran is unfolding rapidly, and it is no longer contained to the streets of Tehran. It is spilling over into global capitals and, consequently, into your portfolio. We are seeing deadly protests on the ground in Iran. The internal stability of a major regional power is shaking, but markets don't usually panic over internal protests alone. The panic comes from the external reaction. Washington is fueling the fire. Donald Trump has threatened strong action against Iran. For the markets, this rhetoric is a massive red flag. It signals risk. The fear is not just about regime change, it is about a wider regional conflict. If the U.S. takes strong action, does Iran retaliate? Do shipping lanes close? Does oil spike? When geopolitical risk rises to this level, investors abandon paper assets. Paper assets depend on peace, treaties, and functioning governments. Gold does not. Investors are moving aggressively into assets that hold value regardless of who is in power or whose missiles are flying. They are hedging against a scenario where the Middle East conflict spirals out of control, disrupting global energy supplies and dragging superpowers into a kinetic confrontation. This uncertainty is the first engine driving gold to $4,600. It is the premium you pay for insurance against war. But while the Middle East is burning, the real explosion is happening right here in Washington, D.C. This brings us to the single most dangerous driver of this rally: the war on the Fed. For decades, the global financial system rested on one sacred pillar: Federal Reserve independence, the idea that interest rates are set by data, not by politicians. That pillar just collapsed. Today, Fed Chair Jerome Powell dropped a bombshell that shattered institutional trust. He revealed that the Trump administration isn't just applying pressure. They are threatening a criminal probe against the central bank. Let that sink in. The president is threatening the bankers with jail time if they don't bend the knee. This is no longer monetary policy. This is a hostage situation. For investors, this is a nightmare. If the Fed is forced to print money or cut rates to avoid prosecution, the US dollar ceases to be a currency. It becomes a political tool. The market knows this. Investors are dumping the dollar because it now carries political risk. They are fleeing to gold and silver for one simple reason. Gold cannot be subpoenaed. Silver cannot be intimidated by a criminal investigation. It is the ultimate vote of no confidence in the management of the US dollar. The third pillar of this rally is the US economy itself. Even without the war in Iran or the political war in Washington, the economic fundamentals are flashing warnings. The US economy is showing undeniable signs of slowing down. The engine is sputtering. Job growth has cooled significantly, signaling that the labor market is cracking. Why does this matter for gold and silver? Because a slowing economy forces the hand of the Federal Reserve. Markets now expect at least 2 interest rate cuts this year. This is basic economics, but it is powerful. Gold and silver are non-yielding assets. They don't pay you interest to hold them. When interest rates are high, money flows into bonds and savings accounts. But when the economy slows and rates fall, money becomes cheaper. The opportunity cost of holding gold drops. So, we have a perfect storm. We have a slowing economy that requires lower rates. Lower rates make the dollar weaker and gold more attractive. But here is the catch. Usually, the Fed cuts rates calmly to support a soft landing. But now, with the political pressure we just discussed, the market fears the Fed will cut rates, not because it's the right thing to do, but because they are being forced to. That smells like inflation. That smells like currency debasement. So, today's rally is the result of these 3 forces colliding. Geopolitical risk from Iran, the uncertain future of the Federal Reserve's independence, and the expectation of cheaper money due to a slowing economy. To really understand $4,600 gold, we have to stop looking at it as just a commodity. We need to look at history. Gold and silver have always done more than just track inflation. They act as the barometers of world peace. They don't predict war, but they measure fear. And right now, the fear index is off the charts. Look at the historical pattern. It is undeniable. In the 1970s, the world was shaken by oil shocks and the Cold War. What happened? Gold prices doubled after the 1973 oil embargo. In 1979, during the Iranian Revolution, echoing what we are seeing today, gold surged again. In the 1980s, amid the Soviet Union's invasion of Afghanistan, gold hit a then-record high of $850 an ounce. Silver exploded even more violently. Move forward to 1990. Iraq invades Kuwait. Gold jumps within weeks. After 9/11s, gold began a decade-long bull run, driven by the war on terror, massive government spending, and global instability, taking it from $250 to nearly $1,900 by 2011. And again in 2020, when the pandemic shut down the world, gold rushed to new highs. Why does this keep happening? The answer is simple. Gold is neutral. It does not belong to any government. It is the only financial asset that is not someone else's liability. It cannot be printed by a central bank. It cannot be sanctioned by a foreign policy decision. When trust in institutions falls, whether that institution is the White House, the Fed, or international treaties, trust in gold rises. We are currently living through a period where trust in all these institutions is hitting rock bottom simultaneously. Now I want to pivot to silver, because while gold is the headline, silver is the story that smart money is watching. Silver at $84 an ounce tells a slightly different, and perhaps more urgent story. Silver is a unique beast. Like gold, it is a safe haven asset, but unlike gold, it is a critical industrial metal. You cannot build the modern world without silver. It is in electric vehicles. It is in solar panels. It is in the defense technology and guidance systems of the very missiles that might be used in the Middle East. When silver rallies alongside gold, as it is doing now, it is a signal of something deeper than just short-term fear. It signals expectations of a longer period of global stress and supply chain fragmentation. We have to place this in the context of the silent economic war between the US and China. China dominates the processing and supply chains for many critical metals. As the US economy slows and political chaos ensues, there is a fear that industrial supply chains could be weaponized or disrupted. Silver at $84 reflects a potential shortage. If the world is moving toward a conflict economy, building more defense tech, more independent energy grids, demand for silver skyrockets. But if the mining supply is disrupted by geopolitical tension, or if countries like China start hoarding strategic metals, which they are, the price has nowhere to go but up. The market is realizing that silver is undervalued relative to its strategic importance. The paper market for silver has suppressed the price for years, but with physical demand rising from both investors scared of the Fed and industries scared of supply chain collapse. The dam is breaking. This is why many experts call gold and silver the most reliable indicators in the market. They are flashing a warning that trust is shaking, risks are rising, and the world is bracing for turbulence that paper, money cannot fix. So what is the takeaway from this historic market move? The surge to $4,600 gold and $84 silver is not a fluke. It is a rational reaction to an irrational world. We are seeing the convergence of a kinetic crisis in the Middle East, a constitutional crisis in the U.S. banking system, and a structural slowdown in the U.S. economy. The threat of a criminal probe into the Federal Reserve is the catalyst that changes everything. It tells the world that the U.S. dollar is no longer above the fray of partisan politics. It tells foreign nations and domestic investors that the rules of the game are changing. And when the rules change, you don't want to be holding the assets that depend on those rules. You want to hold the assets that wrote the rules of value for the last 5,000 years. Long story short, when gold and silver hit records like this, they aren't just making headlines. They are issuing a warning. The trust in the system is eroding. The triple threat of geopolitics, Fed politicization, and recession is here. The world doesn't fit into neat boxes anymore. The lines between economics and war, between politics and finance, are gone. And as long as Washington fights with the Fed and tension rises in Tehran, the path of least resistance for gold and silver is higher. This is the new reality. Adjust your expectations accordingly.